According to the Pew Research Center, more than half of American families invest in the stock market in some capacity. Pew Research indicated that 52% of American families participate in the market through their retirement accounts, compared to just 14% of American families who directly invest in individual companies. You may expand your wealth and have more financial security as you approach retirement through investing, which can help you make the most of the money you can earn. However, there are a few things you should be aware of before putting your toe into the stock market if you haven't already started investing. 1. Before you even begin investing, conduct a financial audit. You should first have a plan and feel financially solid before taking on the risk of investing your money in the stock market. Take the following bits of advice into consideration before you begin. Determine your monetary objectives. Most likely, the reason you invest is to begin saving for retirement. Whatever your objective, the first step is to define it, followed by quantification. Put your objectives in order of significance and urgency. What objective do you want to focus on first? Recognize your cash flow. It's critical to understand how much money you bring in each month and how much you spend. This will ensure consistency in your savings and, ultimately, your investing. Maintain an emergency fund. Before investing any money in the market, be certain that you have a cash reserve that you can quickly access. You can use this money if necessary, such as if you lose your work or have to pay an unforeseen bill. 2. Make the most of retirement accounts. It's low-hanging fruit when it comes to investing, which is why the majority of Americans participate in the market through their retirement accounts. In addition to offering tax advantages, retirement accounts make it simple to make contributions. The regulations governing 401k programs also mandate that plan sponsors offer at least respectable investments at a reasonable cost. Make sure that a portion of your paycheck is automatically put in the account each pay period if you have access to a workplace retirement plan, such as a 401k. The recommended contribution range is 15% to 20% of your gross income, but you should do what is practical for your budget and income level. Make sure you are contributing enough to meet the match if your workplace offers a 401k match. You're leaving free money on the table if you don't. 3. Spread out your investment portfolio. Most financial experts advise beginning investors to diversify their holdings as their first piece of advice. In essence, spread out your investments. You should ensure that the types of assets you purchase, the industries to which they are related, and even the location of your assets are diverse. Diverse asset classes. You should have a combination of equities, corporate bonds, government bonds, real estate, and other sorts of assets. Even if some of these assets, such as government bonds, are regarded as low risk, they nonetheless have lower returns. Stocks often carry higher risk but can result in greater returns. Diverse sectors. In addition to having multiple asset kinds, you should also have assets that are related to various economic sectors. For instance, if you primarily invest in oil equities, you run the risk of suffering greatly if the price of oil declines. 4. Keep costs down. A great way to maintain asset diversification is through the use of mutual funds, index funds, and ETF portfolios. You can keep your buckets full automatically by using an auto deposit method. However, fees are yet another crucial factor to take into account while investing. Although it may not seem like a standard investing suggestion, new investors sometimes overlook costs. Although actively managed mutual funds are common, the cost of all that brainpower is high. Mutual funds frequently charge 2% or more yearly. Even though 2% might not seem like much, it adds up significantly throughout 5, 10, or 20 years. On the other side, index funds often have significantly lower costs, but you'd have to manage your portfolio on your own or pay more for a managed portfolio. 5. Don't be embarrassed to seek advice. If investing were simple, we would all be wealthy. Having experts on your side is always a good idea. It might be really helpful to simply have a genuine person answer your concerns and provide you with accurate information. There are only 24 hours in a day, therefore you should focus on more pressing matters than how your investments are performing. Before, during, and after you sign up, you may contact qualified advisors via phone, email, or even live chat. You're not alone when you invest online. Financial specialists who are leaders in their fields create, oversee, and manage. A manager is in charge of overseeing the portfolios in the interim. Without the exorbitant fees some investment consultants charge, you receive real assistance from real people. To ensure that your money is working as hard as you are, make sure you have a dependable expert by your side while you navigate your financial journey. That's all for today. I hope you liked the video. Don't forget to subscribe to the channel. See you next time.